All right, let's dive into a really fascinating story from the world of interior infrastructure. It's a classic face-off between two companies, Stylam and Greenply. We're going to unpack how their completely different strategies led to some, well, surprisingly different results. So let's get right into it.
So, what's this 10% all about? Well, that's the number you need to know. Between 2018 and 2024, India's wood panel industry grew at a compound annual rate of 10%. That is some seriously impressive growth.
And that huge growth, well, that's the backdrop for our entire story today. You've got this booming industry, and it's a dynamic environment where companies are making some big moves, trying to grab their slice of an ever-growing pie.
But here's where it gets even more interesting. If you zoom in on that 10% growth, you'll see some parts of this market are expanding even faster. We're talking about things like medium-density fiberboard, you probably know it as MDF, and particle board. And guess what? That's exactly where our two companies are playing.
Okay, so it's time to meet the two players in our face-off. On one side, we have Stylam Industries, and on the other, Greenply Industries. Now, both of these are big deals in the industry, but trust me, they are taking completely different routes to the top.
So first up, you've got Stylam. Think of them as the global giant. They're Asia's biggest single-location laminate maker, and they're shipping their products to over 80 countries. That's a massive footprint. Then you've got Greenply. They're more of a domestic champion, an absolute powerhouse here in India, holding down a whopping 22% of the entire plywood market. So right off the bat, you can see these are two very different beasts.
All right, now for the main event, the financial face-off. This is where things get really intriguing, because when you look at the numbers, a real puzzle starts to pop up. Let's start at the top line with revenue.
Okay, so check this out. In the third quarter of a recent fiscal year, Greenply grew its revenue by 10% year-on-year. Not bad. Stylam, only 6%. And Greenply's growth came from just selling more stuff, pure volume. So looking at this, you'd think Greenply is the clear winner, right? They seem to be pulling ahead.
But hold on a second. Does more revenue automatically mean more profit? That's the million-dollar question, isn't it? We need to peel back a layer here and look at the bottom line, because this is where the whole story just flips on its head.
And wow, just look at that. This is the twist. Greenply, with all that extra revenue, their net profit dropped by a staggering 41%. Meanwhile, Stylam, the slower one, saw its net profit skyrocket by 53%. So how on earth does that happen? How do their profits go in completely opposite directions?
Okay, let's get to the bottom of this. The answer really comes down to their two different game plans. One is all about efficiency, and the other is all about sheer volume. So here it is, plain and simple. Stylam's profits soared because their margins were strong. They didn't have to sell a ton more. They just made more money on everything they did sell. Greenply went the other way. They pushed for huge volume, but their margins were super thin. So all those extra sales, they just didn't turn into actual profit.
Now, if we want to really measure this idea of efficiency, there's a great little metric for that. It's called return on capital employed, or ROCE for short. All it really tells you is how good a company is at turning its money, into profits. And yep, you guessed it, a higher ROCE is always what you want to see.
And speaking of higher ROCE, just look at Stylam's track record. They went from 17% all the way up to 27% in just 5 years. That is a massive jump. It's proof that they're getting better and better at using their capital efficiently. It's basically a sign of a really smart, healthy operational strategy at work.
Okay, so what does this mean for their stock valuation? Well, the efficiency story continues here too. Stylam's price-to-earnings ratio, basically what you pay for its profits, is actually lower than Greenply's. That could suggest it's a better bargain. And then there's the PEG ratio, which kind of factors in their growth. It's hovering right around 1, which is often a sweet spot that suggests its growth isn't overpriced compared to its peers.
But of course, it's not all sunshine and rainbows. We have to talk about the risks. Because even though they have these different strategies, they're still playing on the same field, which means they're facing a lot of the same challenges.
So what are those challenges? Well, two big ones. First, the cost of raw materials. If those prices jump around, it can really squeeze those all-important profit margins we've been talking about. And second, the real estate market. Both of these companies depend heavily on construction. If the housing market cools down, so does demand for their products. And that's a problem for both of them, no matter which strategy they're using.
You know, if you had to boil this entire story down to one sentence, it would be this. Stylam was margin-led, Greenply was volume-led. That really hits the nail on the head, doesn't it? It's the perfect summary of these two totally different business philosophies.
So, to put it all together, what we have are two distinct paths to growth. You have Stylam Industries, laser-focused on profitability and making sure their margins are rock solid. And then you have Greenply Industries, which is all about grabbing as much market share as possible by pushing sales volume. Look, both are legitimate ways to grow a business, but as we just saw, they can lead to wildly different results, especially in the short term.
And that really brings us to the final question, and this one is for you to think about. In an industry that's growing like crazy but can also go up and down, which strategy do you think wins in the long run? The one focused on profit margins or the one focused on pure volume? There's no easy answer, but it's a fascinating question, isn't it?